The third factor is clear underlying asset. Okay, what do I mean by clear underlying asset? If I can give you an example here, I think that help you understand better. Number one, for example, we have got different kind of product like saving account, fixed deposit, e-wallet, money market fund, or cash. So all these investment, these are all different type of investment product or saving product, whereby the underlying asset of it is cash. Okay, and then you have got different product like stock, equity, unit trust fund, index fund, equity ETF, equity crowdfunding, macam-macam product, but all the common underlying asset for this type of product is equity. It means it's stock. It means share of a listed company or share of many listed companies. And then you got product like direct bond, you got bond unit trust, you got bond ETF, you got peer-to-peer financing. The common underlying, of this investment is bond. Next, residential property, commercial properties, industrial properties, land. What's the underlying asset of this investment? Property. And then we have got direct REITs, REIT unit trust fund, REITs ETF. The underlying asset is REITs. And how about this? We got gold, silver, crude oil, copper, commodity. Then what is the underlying here? Commodity is an underlying asset. So which means to say, when we invest into an investment and we want to make sure that this investment is safe, the operator of the investor or the provider of this investment must tell us, oh, I am going to take your money and I'm going to invest into the shares. Okay, I'm going to invest into the shares in the Asia Pacific region. Oh, okay, no. And then I'm expecting to maybe target for maybe 15 to 20% return a year for you. Or I'm taking this money from you, then I'm going to invest into this like commodities. I'm going to buy gold, maybe, then speculate on gold investment. So this is a gold commodity fund. So as an investor, oh yeah, gold is quite volatile, then I can expect maybe 20%, 30% return per year. Okay, so in that case, whatever they say they take my 100,000, they know, or they let me know what do they invest into, and then I can match to say you invest into gold, and what kind of return I can expect for that, and what kind of risk that I'm exposing myself to. Okay, now, so if in the case, so in the company say, oh, you give me your 100,000, I'll give you 8% return, and this is 3 years. You give me every year, every 1 year I give you 8% for 3 years. Then after that I give my money back. Then we ask them, what do you invest into? Oh, I cannot tell you. Oh, you don't need to know. So anyway, I give you 2%. I can give you 8%. So will you trust this kind of investment scheme? Do you smell some problem to that investment scheme, whereby the operator cannot tell you what do they invest into, and then they promise you 8%, and then 8% return is not easy to get from the market. No. So the question now here is that if an operator or a investment product provider can't even tell you where are they investing in order to give you 8% return, I would say this may not be an honest and transparent of, I doubt their genuine intention to really grow money for me. So in this case, I normally will ask my client to say, better don't risk your money in this kind of not transparent kind of investment. So I'm sure you know what I mean. There are investment which just tell you the return, but never tell you where do they invest into. It's a black box. Don't invest into this investment that is a black box. Okay, next. No leverage or no margin. You can see here, what do I mean by this? So what I mean is that when you invest 100,000, then which means say you are investing to an investment for the 100,000 value. Got leverage, meaning that you invest 100,000, but you buy some instrument, okay, or some derivative, some option, or you may get some loan, some margin, so that you will put 100,000, but you end up investing in the value of 200,000. So this is what I mean leverage. So I would suggest to say that a safe investment must be an investment whereby you invest purely using your capital, which with no extra liability exposure. Because this is double-edged sword. When you leverage yourself 2 times or 3 times, of course, when you make money, of course, you make 3 times more. But guess what? When you lose money, you also lose 3 times more. That is very dangerous. So that's why you can see here, if I take S&P 500, and then we look at the ETF they are using, here is SPY. SPY. So this is no leverage. But if it's SSO, it's investing in S&P 500 as well, but it's with a 2-time value. So there's a leverage. And UPRO, okay, is a 3-time leverage. So I would suggest, the same go for NASDAQ, Dow Jones, and Russell 2000. So I would suggest to avoid any leverage. So invest in share also, avoid that investment, because some investment may be a moderate risk kind of investment, but the moment that you leverage it 2 times, 3 times, it becomes a high risk investment, and you may not be able to stomach that kind of risk.